Right, so welcome everybody to today's webinar. We are pleased that you're with us and also pleased to be welcoming Rory from our funding partner, Capitalise. So there we are. So we've got myself, Ben, and Rory that will be speaking with you today. We do have the question and answer page open. So if you've got any questions that you are looking to have answered, please do put those details up as we go through. Nick, can you move this? Thanks. So today, I think funding is obviously key to a business. Cash is the lifeblood of all businesses. And I was thinking of something to tee up what we're going to be talking about today and came across this saying, smooth seas don't make skillful sailors. So what I'm trying to illustrate with that is over the past few years, although we've been coming out of austerity, the economy has been fairly good. Businesses have been okay, but those times are a little bit in the past now, to say the least, and we've hit an awful lot of troubled water. I think that the government measures they've put in place in the last few months have smoothed those seas quite extensively with the various loans and grants and actions that they've taken. I think that we are in rough seas, but I also think that there's an awful lot worse to come as we work our way out. And also, as we'll talk later on, the cash flow effect on businesses is going to be stretched as they start to pick up their trade again. But we'll come back to that more later. I just want to now hand over to my colleague Ben, who's going to talk a little bit about where we are with the funding offerings that have been out so far.
Thanks, Neil. So I'm just going to start off talking a little bit about the bounce back loans and the CBILS and really the conversations we've been having with our clients on these the last few weeks. So just a quick summary of the two loans. So just a reminder, the bounce back loans are 50,000 up to 20 or 25% of your turnover. You can access the funds within 48 hours. And the first point of call is your own bank, but there is other options. So if your bank does not currently provide you with this, please do speak to us. And the first year interest is interest and payment free. And after that, you can get an additional 5 years at 2.5%. And with the CBILS, just a reminder that there's up to 5 million, with 250,000 being no personal guarantee. For the CBILS, the banks are asking for a lot of additional information, such as 3 years accounts, cash flows, information on the directors. The interest rate on the CBILS can be anything from about 2.5% to about 9%. And again, your first point of contact should be the bank. So I just want to run through a few points that of the conversations we've been having with businesses and whether you should be considering a CBIL or a bounce back loan. And I think one of the key points that for the conversation we've been having is, okay, you might not need the cash now, but have you predicted forward to the end of 2020 to the start of 2021 what your cash flow needs are going to be over the next nine months to 12 months? At the moment, whilst a lot of businesses are struggling with the grants and the furlough scheme and the other support that the government is currently giving the businesses, a lot of businesses do have cash at the moment to be able to meet their liabilities. But looking ahead to next year, they have deferring their VAT quarter for this quarter just gone. They've deferred their PAYE liability. They've deferred their corporation tax liability. Are they going to need the funds when these liabilities have to be paid to pay them? Have they thought about that? Have they worked into their cash flow when these liabilities are going to be due, and are they going to have the cash to actually pay them? Again, companies who have received the £10,000 or £25,000 grants and also the furlough grants have to remember that that is taxable income that they are receiving. So whilst they're receiving the money, potentially 19% of that is then going to have to be paid over on your next corporation tax return. Have you thought about saving that money to have to pay it when that's due? When the furlough scheme stops and they have to take on the staff and pay their full salary again, have they thought about the additional finance that the company is going to need until the sales hopefully pick back up to what they were pre-COVID? For directors and shareholders, the government introduced a deferral for their July 2020 personal tax payment. But when we look at their January 2021 payment, they're effectively going to have a double hit now. So have they worked through their personal and the company, whether they're going to have the cash to actually pay these funds? We're recommending for some clients to try and get their 2020 accounts and personal tax returns done as soon as possible, so we can potentially either reduce your payment on account and also then work those payments into your cash flow forecast. We'd suggest all business owners to start looking ahead, as I mentioned, into 2021, put together at least a year cash flow forecast. And again, we can assist the business with doing the cash flow forecast. If you're happy doing it yourselves, then great. We think it's a really useful thing to do. But to take into account that whilst the government support is available now, it won't be here forever. So we don't know exactly when the bounce back on the CBILS are going to run to, but we think around September time. So think now, if you're going to need that money, don't wait till September, October, where the loans might stop, and then you'll have to actually start hunting around how you're going to get the money. The Chancellor is also due to make an announcement this week on the furlough scheme and what proportion from August companies are going to have to pay. So we'd also recommend, as soon as you have worked, we've seen how much you're going to have to pay, trying to work different scenarios depending on what staff you're going to bring back and how much of their salary you're going to have to pay, to work through to your forecast to again see what the cash flow needs are. I'm going to pass you back now to Neil to continue on to more cash flow elements.
Thank you, Ben. Thanks for that overview. What I'm going to do now is dig a bit deeper in a very short time into more in-depth cash flow planning and some of the concepts behind it. This slide here is really just trying to illustrate how the business spins and how assets lead to profit, which then leads to cash, and then you decide what to do with that money. It's all pretty obvious really, but each of those elements have got parts that need to go into any cash flow forecast. The cash flow forecast, when you put it together, in essence, can be quite simple. Just put down what my income and expenditure is likely to be. And frequently, cash flow forecasts are put together with a means to an end. Sometimes they're then manipulated to give an answer that you think the bank or the funder might want, and it doesn't actually really stick to what the business is going to do. When you put a cash flow forecast together and look at what's happening in each month, it's kind of almost the end point of an exercise, and that exercise is to really understand what the drivers are behind the business, how they all work, and the timing of things. And when you start to unpick that, then you can start to make effects on the business cycle and all the different things that go into that. For example, faster collection, I'll be talking about that in a minute, of your debtors is obvious, but some not all businesses really look into their process properly and see what things they can do to make a difference. Same as talking to suppliers, stock, and so on. So all these things are interlinked within the process of which ends up with a cash flow forecast. So on the next slide, just saying profit doesn't equal cash. Things that can affect profit have a different timing process for cash flow. And on the next slide, I'm drilling down a little bit more into that process. On the left, we're looking at an overview for someone who's manufacturing or retailing, or anybody that's really got some stock, and some of the different processes in there that cause this phasing of cash. So starting off by buying stock, which you've got to get in, you've got to pay the supplier, and some of that stock will go out immediately, some of it you're going to put on the shelf. It then leads to sales, that money comes in, and only then do you get the cash to provide more stock and go around this circle again. If you're a service provider, you're not going to have so many instances of providing stock, but I would argue that in that case, you're going to have probably higher element of wages and labor costs that you could almost substitute for the same. And it's that cash flow going around that is important to understand what it does to the cash flow and the figures that you produce. On the next slide, I've tried to put some things together, and we've just got 4 basic lines. The blue dotted line is the turnover of a business, and for this example, I'm taking it at quite a low level compared to what there might have been in the past. So starting off with £20,000 turnover in month 1, but then kind of trying to illustrate somebody that had to stop because of the lockdown, except their growth accelerating through the months, 5 or 10,000 a month growth until they get to about 70,000 at the end of month 6. And then the brown dotted line is what is the profit that they're making after they've accounted for all their costs. And I'm trying to show here that it's slightly loss making to start with because turnover isn't high enough. And as it goes through the months, they're covering overheads and costs around month 3 and 4, and then they're moving into profit around month 6. This example starts with £50,000 in the bank. I chose £50,000 because of the bounce back loan amount, and basically saying how this business would survive if they were living off that. On the red line, we're showing if they paid their suppliers in 30 days, but their money took 60 days to come in. As the business grows, it's just accumulating more and more strain on the cash. They're eating their cash, and by the time they get through 2.5 months, they've gone negative and need more funding. And the point I'm trying to make is if that business through the business planning process and cash flow process was to say, look, we've got to do something about these the days that we're taking here, and they managed to make new arrangements with their suppliers and their customers, and they got to paying their suppliers longer, and they get their money in from their customers quicker, then they're on a completely different level, and the funding comes in more in line with what the business can do. And so when you're doing a cash flow process, it's important to flex the possibilities. Once you've got your result, you want to be looking at what the business can do to make it happen better, and how to make sure that you can work within your cash flow requirements. On the next slide, I'm just going to, it just illustrates how these days stack up. So if you're paying your supplier after 35 days, and then you're selling it out and you're waiting 45 days for it to come in, you've got a 75-day profile that you have to fund. And as business starts from a lower starting point, if it is at that now, or it's growing rapidly, this extra demand needs funding. Moving on from there, I've spoken about some of the key issues of poor cash flow: accounts receivable and accounts payable. In a way, they're all kind of straightforward, but each one of them cannot be, or isn't necessarily going to come out that you've got an issue to look at. So accounts payable, receivable, and how you buy your stock are obviously going to impact cash flow. But there's also some other things. So Rory might touch on this later on about having the wrong type of capital, the wrong kind of borrowing for a business. Frequently come across where people are using overdraft instead of loans, and the way the whole funding of the business is not structured in a way that works. And businesses are now looking at that even closer because of arrangements made in the past aren't necessarily appropriate for now. So a lot of things are being refunded and rejigged. Overheads being too high and margins being too low, again, can be significant. And if you can just make small changes to any of these, that can really impact your cash flow. Sales levels being too low, well, that's another obvious one. And is key to all businesses. And I think at times like this, you're going to be relying on the trust and the goodwill that you've got with your customers and suppliers to boost what goes in to the business going forward. And lastly, I wanted to touch on 5 principles about cash, and I've touched on these to start with. So you have to understand what is making your business tick. What are the key drivers behind the cash flow, and how do they work? And that's a bit of a process of understanding and exploring. And quite often when businesses are just ticking over, you can overlook some of the key things because things just happen, and they've happened in the past. At the moment, it's just a really good time to revisit your key suppliers and key customers and re-establish those arrangements. For example, direct debits are easier than before ever to put in place, and that can be a real good basis to get cash in quicker rather than chase things. Using technology better can really improve your debt collection and your credit control process. And so you've got to really look at the underlying causes as well as what the numbers show. And you need to be ready to make changes to your process as to make the cash flow even better. And I would say that when you've got your cash flow forecast done and you've got your funding and you can see what's happening, don't just put the cash flow in the drawer and forget about it. Monitoring monthly or quarterly at the very most your actual results to what you forecast is going to be really key to making sure that you're on track going forward. You can look at what's in the bank, and you can look at what your facilities are, but if you don't compare your actual results to what you forecast, you then can't compare what the business is doing to what you thought it was going to be. So if you're preparing them yourselves or we're helping you, just doing the cash flow forecasting itself for the purpose of raising finance is good for the purpose of getting money in the bank. But in terms of ongoing monitoring, you should really be comparing your management accounts or other KPIs that are underpinning the cash flow on an ongoing basis. So that's a very quick overview of cash flow and some of the principles behind it. And that's where I'm going to end my little section. Apart from saying, you've really got to do something about it. Doing nothing, we don't think is really an option. You should be planning a lot closer than ever before now. Focus on what you can do. If you can't do forecasting, get help from us or somebody else, but make sure that you do something about it. Thank you. I'm now going to hand over to Rory from Capitalise.
Hi everyone. So I think I'll start by just giving you that don't know what Capitalise is, a quick overview. So Capitalise is an advisor-led platform that helps professionals unlock over 105 UK funding providers through one single application. We typically start with the purpose of the funding and then work backwards to find you the most sustainable solution. Ben has touched on some of these points, but I wanted to talk about post-COVID, what we saw, and then a little look into the future of how the funding market has changed. So splitting that into the emergency funding. So the bounce back loan scheme's probably been the most popular. It's been quick and easy to apply for 2,500 up to 50,000. You can do it yourself. There's not a big deep dive into serviceability and underwriting, although the business owner or you must certify the projected revenue for the year. And then looking at more short-term recovery, CBILS has been really popular. So £50,000 up to 5 million. As Ben mentioned, no repayments for the first 12 months, and really importantly, no personal guarantees for the directors. 90% has gone through the high street banks, but actually fintech lenders week by week are being accredited by the British Business Bank to provide these CBILS loans. So there are actually a lot of other options outside of just the bank that you bank with. Ben also touched on, so what happened at the start was the banks tried to put clients onto their own products and then use CBILS as a last resort. That came under a lot of criticism, and now the banks are offering CBILS as a first port of call. They were quite time consuming. Lots of financial information was needed, and this led to a lot of slow decision times. And this is for two key reasons. One was the sheer amount of information that you or the accountant needed to provide. But also, more importantly, perhaps, is the fact that a lot of SMEs don't have a dedicated relationship manager. And actually, this fits in quite well with Davis Grant and Capitalise, as what our platform enables Davis Grant to do is to quickly come up with impartial funding solutions for your business. If we can move to the next slide, please. So effectively, what you can see on this slide are the types of products that Davis Grant can help you access through the Capitalise platform. But what I'm probably going to do is focus on looking a bit further into the future and what we think and predict will happen. CBILS and the bounce back loan scheme are a temporary, scheme from the government to help the situation. But these will not be here probably in sort of 3 to 6 months' time. And the lending market will return to somewhat new, but there will be some key differences. So I think the first one I wanted to talk about was property finance. So in the last few years, unsecured loans have been very popular, and maybe that's due to the speed you can access them, and it's quite easy to get a 5-year loan. But after CBILS and the BBL, I think property finance is going to be quite important. Interestingly, 45% of commercial property is unencumbered. So once the BBLs and the CBILS have run their course, unsecured lenders are likely to be very tight with their criteria and a bit more cautious. So I think we'll see quite a lot of businesses raising money, against mostly commercial property, but sometimes personal property. And then coming out the back of coronavirus, I think we've already seen the invoice finance providers start to open up again. Invoice finance, very simply, you're raising money against a business-to-business debtor to fund growth or to fund a project. But we think that selective invoice finance, with the lenders being very cautious, we think selective invoice finance will be a key way to build your businesses back up the other side of COVID-19. And typically you'll be able to raise about 85% of that B2B invoice. I'd also like to talk about merchant cash advance, the one at the bottom here. Not that it's probably a less well-known product, but I think it can be very relevant coming out of coronavirus. So keeping it simple, a merchant cash advance is useful for retail businesses or any service providers that get paid online through a merchant. That might be someone like WorldPay, Global Payments, Lloyds Cardnet. And effectively what happens is you're raising money against the average income that comes through either a physical terminal or the online terminal. And typically you can borrow about 1 to 1.5 times the average monthly income. These lenders have started to lend again as long as the turnover hasn't dropped by more than 25% pre-COVID. If you're a retailer, your shop will need to be open. It can't be closed. Caveat to that is if you're a restaurant and you're running deliveries, that as long as there's money coming in the terminal, that will be a viable option. And what's quite interesting about this product is rather than having a fixed monthly repayment, I suppose a bit like C-bills and the BBL, where you've got no repayment to make for the first 12 months, with a merchant cash advance, you don't have a monthly repayment like you would in a loan. You only pay the funds back to the lender when your customers or clients start to pay you again online. So it's worth just having an awareness of that. Trade finance, we've got a trade finance specialist at Capitalise who can help with these inquiries. It's quite niche. We don't see that much of it. Working capital, so I mentioned the unsecured lenders are going to be tighter. It's going to be harder to get unsecured lending. And then the final one to talk about is asset finance. So during coronavirus, all of the asset finance lenders, if you've got a fleet of vehicles, plant and machinery, they were only looking after effectively customers that had had asset finance with them. They weren't taking on any new inquiries to buy new assets, and refinancing existing assets was harder. That said, coming out of COVID-19, when cash might be tighter, I think refinancing existing assets can be actually a very cost-effective way to raise funds. If you had a fleet of vehicles or a lot of plant and machinery, maybe they got to the end of their hire purchase term, or wherever they are, you can still look at a refinance. And because there's an actual tangible asset involved, the cost can be cheaper than your unsecured loan. If we could go to the next slide, please. And this final slide, I just wanted to show you how the process works with Davis Grant. So effectively, you would have a meeting or a conversation with your accountant, digging into the purpose of why you're looking for funding and what the long-term plan is for the business. And there's actually quite a lot of evidence that working with your accountant to get funding, you're 4 times more likely to have success. And that's because your accountant will be able to produce up-to-date financial information and to really help the lenders reach a positive decision. So what will happen is the accountant will fill in an online application, one single secure point where all the information is held securely. And then what will happen is one of our funding specialists and the accountant will work with the lenders. You can see down here at the bottom, we work with over 105 different providers offering all of the products on the previous slide. And the aim is just to come up with the most sustainable solution, not the quickest or the easiest. A lot of businesses will go onto Google and look for business funding. And ultimately, quite often that will mean that you get the quickest solution, but perhaps not the right solution. So, we definitely think that the partnership is a really good way of coming up with sustainable funding for your businesses. Back to Neil for Q&A, I think.
Okay, so we're now going to, thank you, Rory, thank you, Ben. We're just going to run into the Q&A session now. So if you both go back onto video and unmute, we'll be able to just pick these questions around. So a couple have come in on the live stream. First one I can see is, what interest rates should businesses be paying on bounce back loans? Well, I think the government fixed that at 2.5%, and that is across the board. No interest for the first year, and then running through that for the remaining up to 6 years of the loan. So 2.5%. Perhaps Rory, you can help on the next one. Can businesses apply for both C-bills and a bounce back loan?
Sure. So when bounce back loans first came into play, there was effectively quite a strict covenant that was saying that if you took a bounce back loan, you could not then apply for more. So there was a bit of a concern that people were taking the quick, easy money for say up to 50,000, but actually they were going to need say 75,000 long term. But luckily, not that long ago, the British Business Bank have changed that. So if you've got a bounce back loan and you need more funding, you can now convert that to a C-bills. What will happen is you'll be asked to refinance the BBL, which might be at 2.5%. So you'll borrow to refinance that, and then you'll borrow a top up. And what you can do is you can do that through your high street bank could give you a BBL and then a C-bills and convert it themselves. But actually you could have a BBL and then also look at non-banking C-bills accredited lenders, for example, Funding Circle and Market Finance. And that both of those accredited C-bill lenders are happy to refinance the BBL.
Okay,
yeah, I've just following on from that. I think I've had some conversations with clients over the last few weeks. That thing that they've needed some urgent quick cash, so they've applied for the bounce back, but more long-term planning, they're going to need more additional cash. So they're now in talks with their banks to try and increase the bounce back into a C-bill.
Yeah.
So, yeah.
I mean, I've had a question here about forecasts, and at the moment, so much is changing. How can we realistically put any figures together? And again, we come across that quite a lot, but I think the way around that is to make your best stab as an initial set of figures, and then do some scenario planning, flex the major constituents within the forecasts, and look at a couple of different types of scenarios. If turnover picks up at a certain rate, or you invest in some more plant and machinery at different timings, play out the scenarios that you've got in your head as to how the business is going to work through the next 6 months or a year, and look at best case, worst case scenario, and what you're going to do within each of those in the key components. And then you'll get an answer on profit and cash flow, and see what the balance sheet looks like under each of those scenarios, and you can decide which one to pitch at. But at the same time, you'll then will cover the basis of best case and worst case scenario. So really, that's just flex them.
I think just leading on from that, in terms of the cash flows that are out there, there is software that we work with that links directly to your cloud-based bookkeeping software. So as time progresses, the figures automatically flex and automatically update. And we've been doing quite a few of these now for clients. And why it is vital to have your books and records up to date as quickly as possible, because you don't want to be doing a cash flow on live information that's then working on 3 months data out of date. The same if you are on cloud-based bookkeeping software. It can also help from Capitalise point of view, because a lot of funders are now linking direct onto clients' cloud-based software to review their funding potential from their actual data. Rory, is that right? You've seen quite a lot of providers now doing this.
Yeah, that's correct. Yeah.
And also on the being up to date point, Ben, we have to have a starting point for cash flow forecasts. You can't just start unless the business hasn't been in operation before. You've got a starting point of zero.
Exactly.
Working businesses, we need to have a starting point, which is usually, well, it has to be the last set of management accounts. So if your data isn't up to date, producing management accounts up to, for example, the end of May, so we can then do forecasts from June through to next May, is going to be a bigger exercise than it should be. So everything is becoming more linked and easier to do with software as it is now.
Yeah. There's just one question that's come through here. Is there an early repayment charge to repay the bounce back loan? So no, there isn't, which is another reason why a lot of our clients have been taking the bounce back loan, because they're using it as a protection that for the first 12 months, if you take the loan and you might not need it, you can repay it after 12 months or even earlier than 12 months, and it's not cost you a penny. So there's no early repayment charges at all for those bounce back loans.
Should I pick up the question that's come through regarding, are there any high street banks or challenger banks that you've seen easier to get a bounce back loan from, or CBILS? So on the bounce back loan, BBL side of things, Starling Bank and HSBC have probably been slightly ahead of the curve in pushing BBL. In terms of CBILS, really it's your main banks that offer CBILS: Barclays, Lloyds, NatWest, and HSBC. But the alternatives to that probably not challenger banks, but Funding Circle CBILS is quite competitive. APRs are always less than sort of 9%, normally between sort of 5 and 7%. And Market Finance also has a CBILS offering. So those are your sort of main options. Hope that answers that.
Just jumping on that, Rory, actually one of my clients went for a CBILS last week through Funding Circle, and they got an approval within 3 hours, which is record speed when banks are sometimes taking 2-3 weeks. So there's a limit of 250,000 for CBILS through Funding Circle. If you're struggling to get through to your bank, that is a really good option for a lot of businesses.
Definitely. And you also don't have to, with the Funding Circle CBILS, there's no repayment at all for the first 12 months. So it's a good contingency to have in your back pocket if you're waiting for a while for your bank to come back to you.
And is there any early repayment charges on that one, Rory?
No.
Nothing as well.
No, you can settle whenever you want after 4 months, and you'll only pay interest up until the point of settlement.
Perfect.
And on the bounce back loan point that you made, Rory, about Starling Bank being easy, for those that don't know, that's an online business bank, and setting up accounts with them is very, very easy as well. So you don't have to go through the same process as a high street bank. It's very, very streamlined, and we're doing that with quite a lot of clients at the moment.
Yeah,
So
you don't even have to move your whole banking over to Starling. You can effectively open a business bank current account and apply straight away for a bounce back loan, and have the funds within 48 hours of even opening the account. So if your bank doesn't currently offer it to you, or you're just struggling, please do speak to us or go direct to Starling, because that is a great option.
Yeah. Okay. Right. What's the best way at the moment to raise funding for a new startup business? Yeah, great question. Always tricky, a new startup business. I suppose it depends how much it needs and how long for. I think you're going to have to, if you're not funding it with your own capital or through friends and family, raising money through banks at the moment is going to be harder, even with a strong, compelling case. I think banks are so crammed out with dealing with bounce back and CBILS rejigging existing lending, and whilst they do want to support and lend to new businesses, it's just going to be harder. So I think the best way is self-funding or asset finance, or I think you've got to drill down into all the different components and break it down into getting, and one of the points we said at the beginning was getting the right funding for the right type of criteria. So don't immediately think I need an overdraft, or don't immediately think I need HP. You know, speak to us, and we can speak to the guys at Capitalise. There's so many different options out there to get the right funding for the right purpose. So that will help too.
I think also if you are looking to kind of third-party investors, to speak to us about the potential tax schemes, EIS, SEIS, because they're very attractive for investors. And if you're a new startup business and you can't get hold of debt finance from a lender, that could be another route to go down.
Someone's asked, when will CBILS loans be running to? I don't think there is an end date for them yet. It will be when the government switches them off. I think it depends on how the economy picks up. Have you had an end date for when they're going to be stopped, Rory?
No, we haven't. And actually, it's more a case of lots of non-traditional lenders being accredited. So in answer to that question, it will be one to keep an eye on until the government say it stops. But there's going to be more and more CBILS choice. I'd imagine in the next month at least, maybe even further into the future.
I think they're going to keep that open, because my take on it is that the economy will need more funding through the autumn and into the spring as it recovers. And my graphs and what I was saying about businesses and growing, all that growth is going to need to be funded. And businesses that are at a lower level now, even though they've got some cash in, if they've spent that out to cover overheads and costs and there isn't as much fat on the bone, getting the economy going is going to need more funding than is out there now. So hopefully the CBILS will carry on. That's just my take, by the way.
There's a question here for you, Rory. What if I have existing debts? Will this affect the serviceability of the CBILS and the bounce back?
Yeah, so good question. On the bounce back loan side of things, and you might be able to add something, Ben, but I don't think it's an issue if you've got existing debt. The BBL is more, you certify what your projected income would be for the year, and as long as you're actively trading in December 2019, you should be okay for that 50,000. It's, from what we've seen, it's quite rare that you don't get approved for that. CBILS probably a bit more complicated because the banks are really digging into the financials, and particularly they're looking at retained profit. It's not actually massively to do with the size of the business. They're looking at serviceability. So they would build in your monthly commitments on existing debt, look at the retained profits and see if it's, still serviceable like that. But I know certain lenders, especially funding circles, CBILS, for example, they're funding their own clients that had exposure of £80,000. They will then refinance those and top them up on CBILS, so long as it's serviceable. Funding circles serviceability is probably less stringent than a bank because they're a peer-to-peer lender. They don't have to abide by the same serviceability metrics that a bank would. But yes, they will be taken into account.
Yeah, I think on one thing that the British Bank does state is that you have to, for a bounce back, you have to self-declare that as of the 31st of December, you were not a business in difficulty. And that's effectively that your reserves are greater than a 50%. So yeah, it's a self-declaration that you've got the reserves there, and that the business as at the end of December was not in difficulty at that point, and has only gone into difficulty because of the bounce back. I think for the CBILS, like Rory was saying, the banks are looking much more in depth on it, and especially the high street banks. You can't be seen to be using the CBILS for anything but COVID cash flow issues. So whether it's looking for business growth or to take on new staff or for an asset purchase, anything like that, it can't be seen to be using to help grow the business. It's just to effectively cover the difficulty that the businesses have gone into. And that has to be shown in your cash flow and in all the blurb that you give to the banks.
Agreed.
Something on invoice discounting. With customers delaying on paying invoices, what is the bank or finance provider's view on invoice financing currently?
So I'm happy to answer that.
Please, yeah.
So the invoice finance lenders, in fact, out of all the different products, they probably kept lending more than most, and they're starting to open up again. We've seen quite a few chunky invoice finance lines be approved even during coronavirus. And yeah, we think the likes of Market Finance, Satago, Ultimate Finance, they will be key lenders as we come out the back of coronavirus.
Yeah. And they still is the same kind of recoverability criteria, and if the debts are over 90 days, they're going to fall off. Is that, have they changed those at all, or is it just kind of winding through as it was?
To be honest, I'm not 100% sure on that, but I can definitely speak to our lender manager who speaks to those invoice finance lenders daily and find out if there's any change. But in general, they are opening up and lending again.
I've actually been working on an invoice discount facility for one of my clients the last few weeks, and there's still the same offerings as there was pre-COVID. So 85%. They're still offering the invoice insurance facility. So all the still same offerings seems to still be available. And for clients that have previously been using overdrafts or have an overdraft facility, it could be a much better way of moving forward post-COVID.
Yeah. Last question we've got coming up. So we've just got a few minutes left. So if there are any more questions, please send them through. Do banks take into account the directors' loan accounts when considering applications? Will they review dividends?
Again, I'll find out specifics on it, but I think it's not as important. They're more looking at unsecured debt and maybe higher purchase commitments, as the director's loan is a director's loan as opposed to a business loan. But I will double check and feedback a more detailed response if that's okay.
Yeah, I had a client going for a large loan, a CBILS. This is more relevant for a CBILS and not a bounce back, because a bounce back loan, they don't look into directors' loans dividends in depth at all. But for a CBIL, they do ask what the director has been drawing out of the company and also what the loan position is, and they want you to predict that for the next 12 months. So why has the company managed to get the loan no problem, even though he was drawing money out of the business? They're happy for the directors to continue drawing a salary, but they also looked at his personal expenditure. So if your personal expenditure you're showing to the bank is 100,000 a year, and you're telling the bank you're only going to draw 30,000 out of the business, well, what's filling the plug? So it all has to link together and make sense. And that's why we would say, yes, look, go to your banks, but if they do come for extra information and for cash flows, please do speak to your advisors, because you want to make sure everything ties together and you're not giving them one bit of information saying this and one bit of information saying something else.
Yeah. And if you were looking at a positive director's account, so they put money in, I think those are some of the answers that we were talking about. But if it was the other way around, where you've got a director who's overdrawn their funds compared to the profits and dividends they've taken out in the past, so effectively that director owes the company money, I think that is being looked at closer, and questions are being asked about that. But that links in with the whole question of drawings and serviceability that Ben was talking about what can the company afford and how is that being funded. So I think we are there. We've out of questions. Thank you all very much for that. Rory, thank you very much for your input. And it's very good to be working with the guys from Capitalise. It certainly has given us a lot bigger avenue for far more varied funding streams to help clients and businesses with and get very quick answers on all kinds of different options that are out there across the board. And it's been a real good support to us. So thank you for that as well.
I'll just add to the attendees, this has been recorded. So if you have any colleagues or anyone that you think this is would find this relevant, please do send the link around.
Yeah,
and share.
Thank you. And my closing call is, like I said at the end of my presentation, recommendation is that you do something. It's now more important than ever to look at your cash flow, consider what's going on in the business, think it through, think in depth about what's happening, what's making the wheels turn for you, and do your different scenario plannings. Look at best case, worst case. Don't bury your head in the sand thinking it's not going to happen to me. This is not the time to be having that viewpoint. Whilst the seas are steady at the moment, there's, to go back to the first slide, there could well be rougher times to come when the furlough scheme unwinds, the unemployment numbers start to hit. I'm not painting a doom and gloom picture here, just saying be realistic. Think about your businesses, work it out, and if you need help, you know where we are. Always here happy to talk and help. So thank you very much, and hope to see you again soon.
Thanks all.
Bye bye.